Good evening, everyone. Welcome to our VCU Homebuyer Workshop. My name is Jason Maida. Great to be with all of you this evening. Really excited to bring this presentation to you. Hopefully you're having a great kind of midweek so far. And it's great to be connected with everyone. I know we have quite a few that signed up for tonight's class, and you guys are kind of getting into the class right now. So while we're waiting for everybody to join us, just want to talk a little bit about logistics for tonight. Our runtime for tonight's class is just about an hour. This is a very interactive session. So as we present tonight's content, we'd encourage you to ask questions of us. Myself and my colleague Ken will be kind of answering those questions as they come in. You can either use the chat feature within Zoom or Q&A. We'll answer those questions on air. We'll also carve out some time at the end of tonight's class to answer any follow-up questions that you have. It's always interesting as I teach these classes across the country to get a sense of where we're joining us from, and especially we're in this virtual environment. So if you have a moment, if you can just drop in the chat where you're joining us from, I'd love to kind of get a sense of, where all of our classmates, so to speak, are joining us in the country. So if you can just put like your location, that would be awesome. And the reason why that's kind of helpful for us too is because we're going to talk a little bit about housing market data tonight. And so it's always, helpful for me to get a sense of where we're thinking about buying or where we live, because then I can kind of design things appropriately. So most of us in Virginia, I have somebody in California. That's awesome. Very cool. Most of us in Virginia. Thanks for dropping that in. I appreciate that. Richmond area. Okay, cool. Very nice. All right. Well, thank you for doing that. And again, that'll be helpful for us when we get to this segment around the housing market. I do think you picked a great time to join a class like this because there's a lot going on in the economy. Of course, what's going on in the economy is going to impact housing buying, home buying, I should say. So really, I think it's a great time. If you're considering home ownership in the next year, 2, 3 years, I think this is a great kind of stepping stone for you. A little bit about me. My name is Jason Maida. Again, I'll be your presenter tonight. We're happy to be in partnership with VCU, and so that's why you're in connected with us for tonight's class. We are a company that's basically spread across the entire country, but we are a California-based company. But we work with all of our clients in a virtual setting like this. So, and we're licensed in all states across the country. So we do specialize in first-time home buyer programs. So you're going to learn a little bit about some of those in your respective states. I know most of us are in Virginia. We have a few of us from California, but we're going to talk a little bit about national first-time buyer programs as well. For our talking points tonight, we are going to talk about the housing market. We're going to do a rent versus buying analysis in just a little bit. We'll also spend some time talking about interest rates. That's probably one of the biggest hot topics right now in our classes is what's going on with interest rates, what's affecting interest rates, and what's kind of the projection from a go-forward basis. We'll also take a look at credit. We'll talk a little bit about student loans and how those can impact qualifying loan programs that are available to you as a prospective buyer. We'll talk a little bit about savings for home ownership and what that might look like for you, and also look at down payment assistance programs offered in your respective state. And then finally, we'll kind of wrap up tonight's class looking at the buying process. So after tonight's class, you may say, hey, I want to learn a little bit more about home buying and what that path towards home ownership looks like for us. We'll show you kind of what next steps can be and kind of share with you more about what a personal consultation looks like for you as we design a home buying plan. Well, that's kind of our plan for tonight's class, and let's kind of dive right in and let's kind of launch into thinking more about home buying. And really, we ask the question of, does buying make sense for me, right? And I think we have to first kind of step back for a second and think about all of the things that come along with owning a home, And so whether you're buying a single family home, maybe a condominium, a townhouse, there's different benefits that come along with owning versus continuing to rent or whatever your housing situation is today. One is we're creating stability in that monthly amount that we're paying, so we're not worried about our rent increasing on an annual basis. Generally, home values will increase over time, some at rapid levels than others, but ultimately, the home value should increase over time. And the difference between what your home's value is versus what you owe on a mortgage is called home equity. And this equity position is generally one of the biggest assets for most existing homeowners. In fact, that asset can help create generational wealth for families. There's also benefits that come along with potential tax benefits that can come along with owning a home as well. So what I encourage buyers to do when they're considering home ownership, don't necessarily look at my payment of renting today versus my mortgage payment in tomorrow, but more so kind of also factor in all of those benefits that come along with owning a home. So as we launch into tonight's class, one of the places I always like to start our classes is to visit this rent versus buying calculator. And this calculator is going to kind of help frame that up for us. So what we're going to do is we're going to actually go through a real-time example as a class, and I'm going to screen share this calculator. This calculator is brought to us by Freddie Mac. And as a side note, all of our presentation material tonight is going to be sent right out to you via email. So for those of you that obviously you've signed up for tonight's class, you're going to get distributed the presentation material. And we're also recording tonight's class. So if you like the content that you're hearing tonight, this will be up on our YouTube channel tomorrow. You can share that link with friends, family, maybe coworkers that missed tonight's class. All right, so let's talk a little bit about this rent versus buying calculator. And so we've got to kind of pre-filled everything just to keep us on track for tonight's class. But let's take a look at what this looks like. So we're going to have some assumptions that we've made in here in this calculator just to kind of walk you through the logic behind this calculator. But it first starts off from a rental perspective. So if I'm assuming I'm paying rent of $2,000 a month, then we also want to factor in monthly renter's insurance, which we have at $15 expected on a monthly basis. And then we also assume that our rent will go up about 5% on an annualized basis. Okay, so that's kind of the backdrop for the rent side of things. And then from a home purchase perspective, we said that our home purchase would roughly be about $400,000 in price. We have down payment we're going to put it 5% for this calculation. We have property taxes that are generally estimated at somewhere between 1.1 to 1.25% of my purchase price. So we kind of bake that into our calculation. We have homeowners insurance. We have the maintenance cost of purchasing a home. So thinking about like what expenses might come about when we own a home. And then this next tab is going to be around loan information. So when we think about the loan information, we're looking at the interest rate that we have for the mortgage, how long I'm going to be paying on my mortgage. We call that the term. Now, the average interest rate is somewhere around 6.1% today. We're going to talk more about that in just a bit. But when you have an interest rate on your mortgage, you as a consumer have the option to pay what we call as discount points to bring down that interest rate. Usually one discount point is the equivalent of 1% of my total loan amount. And as a rule of thumb, that will usually bring down my interest rate about 0.25%. And so those are options that consumers have as additional expenses in their home. But at the same time, that's not something I necessarily recommend right now because especially in the market we're in right now, many buyers that are purchasing in today's market will probably refinance in the next year or two. So you can't really get a good return on investment on discount points at this time in the market. Now, the other expense component to buying is origination charges. That's what a lender will charge you for your financing. Those are called closing costs. And the total closing cost for a home purchase between lender fees, third-party fees like title, escrow, or attorney fees, depending on the state you're in, can generally be about 2 to 3% of your total purchase price. Now, one of our added benefits for VCU alum is we actually discount our origination charges by $750 for you. So when you decide to get on that path towards homeownership and you partner with us, you have that discount as a VCU alum. All right, and then the last section is other assumptions. So in that other assumptions tab, we're going to assume that this home will appreciate about 4% on an annualized basis, that I will be in the home for the next 7 years, that when I sell my home in 7 years, roughly my costs will be about 10% with closing costs and realtor fees and whatnot. And then we have state and federal taxes. And then finally, we have a savings rate comparison. So what our calculator does is it first of all kind of tells us, if you guys kind of look at this part of the screen here, we have the total payments on a monthly basis, right? So clearly renting is going to be a much cheaper month-to-month option because right now it's $2,000 a month. If we decide to purchase, now we've elevated our budget by about $1,100 per month. So that's clearly a big step up, right? At the same time, if we do our total cost opportunity over 7 years, so we rent for 7 years versus owning for 7 years, that's where the opportunity comes for us. Because if we decide to purchase in today's market, we have about a $69,000 opportunity of owning versus renting. And how we get there is the appreciation in the home, which is a big part of home ownership, and then tax benefits that come along with owning a home. Now, everybody's scenario is going to look a little bit different. I'd encourage you, when you have a free minute, take some time, dive into this calculator yourself. I think it'll be a nice exercise for you to go as kind of the starting point for you in home ownership. But that's kind of what a rent versus buying calculation would look like for you. Now let's kind of keep it moving here, and we'll jump back into our slideshow, and let's talk a little bit about the housing market. I kind of led into that as we started tonight's class. And so we're going to take a look at the Virginia housing market, and specifically, we can also talk about other markets across the country. The Virginia housing market doesn't look a lot different than other places in the country. The price point might look different, but the trends in the market don't look a lot different. Now, when I look at the general housing market right now, typically we see seasons in the housing market, right? And generally, April and May is about the time when future buyers decide to get pretty excited about looking at homes. Weather gets a little bit nicer, starts warming up in certain parts of the country. And so people are out and about, start looking at places. Maybe we're considering about moving our kids to a certain school district, whatever the case may be. Generally, it starts to happen in April or May. However, 2024 has been a little bit different. We haven't seen that buying cycle kick into about July, August. And I think a lot of it was driven by interest rates, which we're going to talk about in just a bit. But I think now the kind of consumer mindset is really interest rates probably aren't going to move that much. And so maybe now is the time to get in the market. So you are seeing some buyer demand start to pick up. We'll probably feel the effects of that in the housing market. You can see kind of a little bit of a decline in prices. Some of that's just cyclical because of now we're in the fall and winter months. But we still have a bit of an inventory challenge across the country. So not a lot of supply to support buyer demand. What's interesting is we're going to talk about interest rates in just a bit. So that continued downward pressure on interest rates will continue to fuel buyer activity. But however, if buyers don't have the supply out there to support their needs, then we could see prices start to push up, especially as we're in these fall and winter months. So buyer activity has certainly picked up quite a bit. Now, depending on where you're at in your timeline for future buying, you know, that housing market may look a little bit different. If this is a goal for 2025 or 2026, this could look a little bit different. So, but in the now, we're certainly looking at what inventory is available across the market for buyers. Now, interest rates are changing quite a bit. You know, if I look at the first quarter of this year into the second quarter, rates were at elevated levels. I mean, we're still at elevated levels, but not to the extent we were earlier this year. You know, rates were in the high 7.5, low 7 range. Now we've seen rates, as you can see by our slide here, you can see kind of our interest rate activity over the last 12 months. In fact, back in October of 2023, rates hit at 8% high, which was a 20-year high. And that obviously changed things quite a bit in the housing market. But you see kind of, we've seen this little roller coaster ride that we've been on for the last 12 months. Thankfully, in the last 4 or 5 weeks, we've now seen rates start to slide down to that 6.1 average level. I think it's important to understand as a consumer, like, how do we get to these elevated interest rate levels? And the reason for that is the Federal Reserve ratcheting up the federal funds rate because of the kind of need to combat inflation. All of us feel it on today's call. We feel the cost of fuel, the cost of goods, cost of housing, all of those things are impacted by this inflationary environment. And the Federal Reserve has kind of ratcheted up rates to try to kind of slow the economy down, basically, from that perspective. The inflation goals for the Federal Reserve is 2%. We're currently not at that level, but we are improving. And so that's why you saw 2 weeks ago the Federal Reserve cutting rates by 0.5%. I think it's important to understand, like, what does that mean for us as buyers? Well, the 0.5% cut is not a direct correlation to mortgage interest rates falling, but the speculation of interest rates from the Federal Reserve being cut does bring fuel to interest rates coming down slightly in the mortgage space. And we've already seen that. In fact, as we kind of look ahead at interest rates, the Federal Reserve is potentially making 2 more cuts this year. That's kind of up for debate right now. I think right now it's about a 60% chance of another cut in 2025 or 2024, I should say. But we are expecting 4 more rate cuts in 2025. So, you know, a lot to be seen ahead in the economy as it relates to interest rates. But certainly we're on a good trend for interest rates. You know, I tell buyers that we work with today, time is on your side from a rate perspective, but we'll have to see what that does from a housing perspective. Now, interest rates aren't the same for all buyers. I think that's important to understand. You know, credit eligibility plays a role. So the higher my credit score is, that the better my interest rate can be, the type of product I'm using, how much I decide to finance, what my down payment looks like. And we talked a little bit about it earlier, which is discount points. So if I decide to pay additional expenses, that can help bring down my interest rate. And then the term of my loan can also change what my interest rate looks like. Now, as I get a chance to meet with clients and develop their own home buying plan, we're going to strategize together and figure out the right design for you to help you on that path towards homeownership. So everybody's situation financially looks a little bit different, but we're obviously here to help support you with all those tools and resources that you need during that consultation. Now, credit is a major component of home buying, right? And when I think about home buying for all of our buyers across the country, there's usually kind of two challenges or areas of opportunity. It could be around savings. I just don't have quite enough savings to help me get to where I want to be homeownership wise. Or it could be credit because maybe I have a little bit too much money on my credit cards, or maybe I've had some past challenges with credit. All those factors could maybe slow down my objectives of homeownership, right? So in our classes, we like to talk a little bit about credit to give you some kind of tips to help you on that journey through credit. And so let's first of all talk about what the FICO score calculation looks like. Now, many of you on tonight's call have some type of monitoring system, right? Either through Credit Karma, through your credit card system, or maybe through the credit agencies. Now, we all know the credit agencies, the three agencies are Equifax, Experian, and TransUnion, right? They all have different monitoring tools. Guess what? They also have different risk scorecards too. So they all kind of look at credit a little bit different. There's also different models to the different type of financing that you're going to do. Now, this happens to be the mortgage model that you see on screen. So I kind of want to walk you through the different areas. 15% is going to be how much credit is new to me. So if I look at my credit profile, how long have I had credit? That's going to be a 15% weighting. So if I've only had credit for the last 12 months, that will probably push my score down as opposed to someone that's had credit for the last 12 years, right? And then we have 20% is going to be how much new credit am I trying to obtain? So do I have new inquiries on my credit? Do I have new accounts that I've opened? All those things will make up 20% of the weighting. Now, one of the things we do in working with clients, we only do a soft credit check. And there's a difference between a soft check and a hard inquiry. And the difference is a soft inquiry does not impact your score at all. It just gives us, the lender, visibility to your score. A hard inquiry will put an impression on your credit report. And you got to be careful that you don't have too many inquiries because then you could see some pullback in your credit score. Now, there is a credit rule in place for both auto financing and mortgage financing that says that I have a 30-day window of time to apply with as many lenders as I want. It's the equivalent of one credit hit to my credit score. So you do have that rule in place. But even that aside, we still like to always start with a soft inquiry for our buyers because many of our first-time buyers, they might not purchase a home for 2 or 3 years, right? So we want to help educate them and get them those tools and resources without impacting the score. 30% is going to be around revolving credit. So we're specifically looking at revolving credit cards, personal lines of credit, things of that nature. That's 30% of the weighting specific to utilization of those limits, right? So if I have a $10,000 credit limit and let's say I owe $5,000 in balances, well, I'm at a 50% utilization level. Now, if you were to ask me, Jason, what's the optimal level of utilization? I would tell you 10% or less. So have that credit line or credit balance, I should say, at 10% or less. So let's have that below $1,000. That'll give you optimal credit score levels. Now, we understand that's not ideal for most of us in our classes. So, if you're at 60 or 70% utilization, we'd encourage you to try to whittle that down below 50%. Once we've achieved that level, then let's work towards the 10% level. Now, here's a tip for you on managing credit card debt. So there's 2 important dates on your statement that you see on your credit card every month. One is the billing cycle date. The second is the due date. And the due date, of course, is when your payment is due, right? But I want you to take a look at the billing cycle date. And here's why that's important. Because the billing cycle date is the date which the credit card issuer sends out all of your payment and basically account information to the 3 credit agencies. And they report your balance, your payment history, what your credit limit is, all of that stuff. So what I'd encourage you to do, if you could get in the habit of paying your payments or paying down your balances before the end of the billing cycle date, there's 2 things that are going to happen with that. One is you're going to bring your balances down to a lower level, which lowers your utilization of credit. And by doing that, that helps you improve your credit score. And of course, improving your credit score is going to give you better options when it comes ultimately to home financing. All right. And then it also kind of creates a discipline for you of like getting on track with paying those payments quicker. So then you can see kind of a better performance in those overall credit cards. And then finally, the payment history is the biggest component of the credit score model. So it's simply how have we paid our bills, right? So if we've had any late payments, those are going to be rated as 30-day lates, 60-day lates, and then 90+ days of delinquency. The more severe on the delinquency spectrum, bigger impact to my score. Now, if you've had some past credit legacy issues, so to speak, they're going to be most impactful in the most 12 to 24 months. So the further I can get away from my late payment event, the better I'm going to see my improvement of my credit score. Now, every loan program has a minimum credit score, and you can see some of those on screen. So depending on what credit product works best for you, there's going to be a minimum credit score required. Now, bigger events like bankruptcies, maybe a short sale or a foreclosure, those will have longer impact items to your credit score. Generally, those items will stay on your credit report per se for about 7 to 10 years. And then if you decide to do balance transfers or just maybe sever a relationship with a credit card issuer, just be careful in closing out credit cards, because when you do that, it can impact you in two ways. One is if that's a very long-standing credit card that you have, by closing that out, it actually pulls away all the great history from the credit model, but it also takes away another one of your totals in your credit limits and could lower your credit score. So just be careful with that before you close out accounts. And then in lending, we look at all three credit scores. So we have all three agencies. They each have their own respective score. So let's say as a buyer, my scores are 780, 760, and 740. Well, from a lending perspective, I'm going to use the 760 or middle score from a qualifying standpoint. That's important to understand because that not only impacts my qualifying, but my interest rate offering, my mortgage insurance, all of those things are factored by that middle credit score. Now, if I have a partner that's going to join me in my homeownership goals and wants to be part of my application, we do look at the lowest middle score between both borrowers. So if my partner's at 720, 700, and let's say 680, well, my partner has a lower score at 700. So that would be used from a qualifying standpoint. So, that could impact how expensive ultimately my financing is going to be, because that mortgage insurance will be a little bit higher with that 700 credit score. The interest rate might be a little bit higher. So those are all factors that we kind of talk through as part of our home buying discussion. So this is a matrix that will kind of show you how long past legacy items will stay with you on your credit report. Keep in mind, the most recent 1 to 2 years from the date of the event are going to be the biggest impact to your score. But as I move further away from the event, so let's say I had a late payment back in October of 2022 on a credit card, right? Once I get to beyond that 2-year mark, I should have some decent recovery in my credit score. But if I had a credit card late payment in August of 2024, well, I'm still within a couple months of that date. So I'm probably have a big impact to my credit score. One thing I would also just say on the credit cards, just to kind of go back a little bit, be careful on over limits too. I've noticed that on credit reports. So if you happen to have a $1,000 credit limit on a credit card, and maybe you inadvertently went over a $1,000 limit, maybe it was because the interest they charged for the billing cycle, or because maybe you just charged too much, that will really impact your score right away, because now you're over its limit. So that will pull down your credit score. So really, if you're getting close to those credit limits, just be very careful, because you certainly don't want them to report an over limit amount. All right. Any questions from the audience before I hop into student loans? I know I've thrown a lot of material at you so far, so I just want to make sure that I pause here for a second to catch us all up. But any questions we have from class so far? And again, you can answer those or ask those questions. You can use the chat feature, or feel free to use the Q&A, whatever works best for you. All right. I don't see anything yet, but if we have something, just go ahead and drop it in there. We'll take a look at it. So let's talk a little bit about student loans. I think student loans are an important conversation to have. I mean, some of us may have student loan cancellation of debt, and that's awesome on our federal student loan debt. Some of us might be in forbearance or deferment. I think it's important to understand that if you are in forbearance or deferment, we still have to count a minimum payment when it comes to qualifying for the mortgage. So if I have, let's say, $75,000 in student loan debt, but I'm back in school, maybe I'm working in my graduate program, just because you're in deferment, if you're trying to apply for a mortgage, you still have to have those payments or minimum payments factored into your mortgage qualifying. Now, there's two different ways we look at it. On a conventional loan, if I have that as my product selection, we will take 1% of the total balances as your monthly payment. So that would be $750. Or if we're doing an FHA loan, it's usually 0.5% of the total balances, which would be $375 for qualifying purposes, right? Now, if I'm on an income-based repayment amount, so let's say I'm in active repayment, but based upon my tax filing for 2023 or 2022, I'm paying a certain amount at a lower rate, then that's the payment we can use for qualifying, whether that's $0, whether that's $10, whether that's $100, right? We'll use that from a qualifying perspective. So, I think a lot of the questions I get in classes is, if I have student loan debt or heavy student loan debt, is that going to prohibit me from buying? And not necessarily the case. We just need to see exactly what that monthly payment looks like for you. But I think the takeaway should be if you do have forbearance or deferment, and of course, we saw a lot of forbearance during the pandemic where there's no active payments, even at that time, we still have to count, or at that time, we still had to count a minimum payment for qualifying. All right, so let's dive into loan programs and some of the terminology that I'm going to share with you in just a bit. You've probably heard a little bit about already, but in our classes, we like to kind of spotlight 5 programs for lending. There's a plethora of programs out there, but I think it's really helpful to give you about 5 different kind of paths that you have in homeownership. So let's kind of dive in and look at those. We are also going to spend some time doing a side-by-side comparison of a conventional loan as it relates to mortgage insurance or private mortgage insurance, comparing that to FHA mortgage insurance. We'll do that in our next segment. Well, let's talk a little bit about a conventional loan. So a conventional loan is under the guidance of Fannie Mae and Freddie Mac. You may have heard about them, especially in the housing crisis back in 2008, 2009. But conventional loans require a minimum down payment of 3% up to the conforming loan limit of 766,550, which is basically the national conforming limit. That limit gets updated every year. In fact, we're already instituting new limits for 2025, which is right around $802,000. Those get adjusted every year based upon cost of living. And so, that's our new limit, so to speak. So our next class that we have, we'll probably just institute that 802 number. Now, if we decide to purchase at a higher loan amount that's beyond the conforming loan limit, especially I know we have a few of us from California, or like if you're purchasing in Alexandria, those are deemed like high cost areas where you can finance more than that 766. In fact, you can go up to 1.149 million, but the difference is that the down payment changes from 3% to 5% when we go to those levels. Now, the conventional loan has a minimum credit score of 620. And with a conventional loan, it's going to be a lot less flexible from a guidelines perspective than the FHA loan, because it's really going to look for kind of on-time history from a credit perspective, especially in the most recent 2 to 3 years. The next product is an FHA loan. FHA stands for the Federal Housing Administration. It is a government-insured loan. Minimum down payment is 3.5%, and the loan amount will vary based upon where you're at in the country. So I know we kind of spotlight, I think this loan amount that we have on screen is for the Richmond area at $498,250, but it does vary for different parts of the country. Now, whether I go up to the loan amount of $498,250, or there's also high balance limits as well for the FHA loan, that down payment remains at 3.5%. FHA is going to have a lot more flexibility as opposed to the conventional loan. So in my example earlier, if I had a late payment in the last 12 months, FHA would probably be okay with that, versus a conventional loan might be a little bit more challenging. And as such, like the minimum credit score is lower on an FHA loan too as well. So the minimum credit score is 580 for the FHA product. So FHA is not just for first-time buyers. We have second and third-time users of that program. It just depends on everybody's kind of situation financially. And then the VA home loans for our veterans that have served and have eligibility under the VA home loan allows a veteran 0 down payment option. Can also be complemented with first-time buyer programs as well. The VA loan has flexibility to give inclusivity to the veteran for homeownership. So we want to include the veteran in homeownership, and so we have flexible guidelines. The expense ratios are much more relaxed in the veterans product. It's a great support or resource for our veterans. The 0 down payment doesn't really have a ceiling on loan amount. So depending on where you're at in the country and how much the cost for housing is, you can still do a 0 down payment option. And then the USDA program is for someone that needs to purchase in more of a rural area. That is the United States Department of Agriculture program. It is a zero down payment option. There's different fees that are attached with the USDA program. There's what they call as guarantee fees. But the USDA product has two kind of major qualifiers. It has an income qualifier and also a location qualifier, which basically means it has to be in a deemed rural area. And then finally, there's the jumbo loan product. And those are for clients that need a little bit more resource from a financing perspective because they're buying a higher priced home that might extend beyond the conforming limits or high balance limits for conventional or FHA. However, those jumbo loan products will have elevated down payment requirements, usually 10 to 15%, usually elevated credit score requirements to 680. And there's also additional asset requirements. So traditionally, when I purchase a home, I need to save up for my down payment, but also my closing costs. But with a jumbo loan, we're going to have additional reserves that are in the form of 401ks, checking and savings accounts that are usually the equivalent of 12 months of my monthly mortgage and payment. So if I have an $8,000 mortgage payment, I would need probably an additional $96,000 in assets after I've contributed my down payment and my closing costs. So, as I've talked about before, as we meet with you to connect and kind of develop a plan, we're going to figure out which product matches best for you. But I think it's important to understand kind of the different characteristics that are part of each one of these programs. And one of those characteristics to consider is private mortgage insurance or mortgage insurance, depending on the product you're looking at. So PMI stands for private mortgage insurance on a conventional loan. It ultimately provides insurance to the lender in case there's any default by the buyer. So if the buyer had a hard time making payments, the lender would be protected against that. Anytime I put less than 20% down, I do have mortgage insurance. And there's different ways to pay mortgage insurance. You can pay it on a monthly basis, which is the most common scenario. You can split the mortgage insurance up, pay some of it monthly, some of it upfront. You can do a single premium mortgage insurance where you completely buy out the mortgage insurance. And then there's lender paid mortgage insurance where you take an elevated interest rate in order to buy out the mortgage insurance. Now, monthly mortgage insurance is the most common option. And the reason why is because on a conventional loan, there is a cancellation option. So once I reach 2 years of my loan and I have 22% equity, I'll probably be able to apply to have my mortgage insurance canceled. Now, for those of you in class tonight, if you've started your home search on Zillow or Redfin or any other platform, you might have used their calculators that are on there, and that's great. However, those calculators are usually a bit misleading because, especially when you're looking at lower down payments, the PMI calculation is just not accurate. In fact, PMI is based upon a few kind of key factors. One is it's based upon credit score. It's also based upon down payment and then how much I decide to finance. So the higher my credit score is, the higher my down payment, the lesser I'm going to have to pay in mortgage insurance. So if we looked at a scenario here that we have on screen, we have a client that's financing $450,000. They have a 3% down payment. They have a 740 credit score. Mortgage insurance is fairly reasonable at $183 a month. That credit score goes to 760 or 780. That mortgage insurance would be even more reduced. Now that's on the conventional side of things, and the conventional mortgage insurance is tiered too. So it's almost kind of like looking at car insurance, right? So if you had, let's say, a really fancy car and maybe you drive a lot, maybe because you have a longer commute, like your insurance might be more expensive than someone that maybe has a lesser car or doesn't really drive a lot. They probably have a lower premium. The same thing kind of holds true when we think about mortgage insurance. So that's on the conventional side of things. FHA is a little bit different. Because it is government insured insurance, it does have two components to mortgage insurance. There's a monthly mortgage insurance component, which is 0.55% of the loan amount. There's also an upfront mortgage insurance component, which is 1.75% of my loan amount. Now, with an FHA loan, if we have to go down that path, it does not have a cancellation option. So whether I have 20% equity in my home or I put, X amount of money down, I still have to maintain the mortgage insurance for the full 30 years. Now, ultimately, the FHA loan is almost kind of like a bridge option for our clients to just help them get into homeownership, to access homeownership. And at some point down the road, when it makes sense, we would probably look to refinance into more of, say, a conventional loan product. Now, here's the calculation on mortgage insurance for FHA. So if we take the same loan amount of $450,000, we have to add on upfront mortgage insurance, which you can see from a dollars perspective is $78.75. And then we have the monthly mortgage insurance, 0.55% of the total loan amount. And then we kind of divide that by 12, makes up the $206 per month. So you can see clearly the expense structure looks a lot different in FHA versus the conventional product. However, at the same time, as we kind of design a home buying plan, we have to kind of figure out what's the right resource for you to take advantage of. Because the reality is not all clients will qualify for conventional loans. And so FHA is a great kind of substitute to still have opportunities towards home ownership, depending on what the right fit is for you financially. Now, kind of moving along, we want to kind of talk a little bit about income, because income comes up in the qualifying for home ownership as well, too. And so I like to kind of go through different scenarios with our class. Before we do that, I want to provide you like a quick little checklist of what you think you would need to compile if you decide to kind of pursue home ownership. Usually we need the last 2 years of W-2s, last 60 days of pay stubs, bank statements. Generally, that's what we would see. And then if I'm self-employed, I would certainly need the last 2 years of tax returns in order to validate income. Now, speaking of validating income, we always have to verify 2 years of employment and or educational history. So if I attended VCU, let's say, and I graduated last fall, I just started my job in January, even though I've been on my job less than a year, I still would have my full 2-year requirement, because let's say I did my undergrad at VCU and now I started my job, that would make up the full 2-year history. So there's a little bit of a misrepresentation out there that, you have to have 2 years on your job to qualify for home financing. Just not the case. We just have to make up a 2-year employment and or educational history. So we even have clients that are transferring jobs. In fact, we had a client that purchased their home today. They got transferred out from Colorado to California. They just started their job just this week. They were able to purchase a home, even though they've only been on their job less than a few days. So, that's kind of how the rules work in lending. Now, if you're self-employed, it's a little bit different, because we do have to show 2 years of tax filing in order to qualify for a mortgage. But if I'm a W-2 employee, that 2-year education or work history holds true. Now, if I'm looking to include 2 sources of income, so let's say I'm in the healthcare industry and I work for 2 different maybe clinics, as long as I can show that I've been working at both jobs simultaneously for 2 years, then I can use both sources of income. Also holds true for side employment. Like, let's say I drive for Uber on the weekends, but I also have a 40-hour work week job. If I do want to include my Uber income as part of my qualifying, I have to show that I've been doing both jobs simultaneously for the last 2 years. All right. The last thing I'd like to touch on in the income space, before we kind of talk a little bit about debt to income ratio, is looking at additional sources of income. Like, let's say my partner wants or my partner contributes to the household from an income perspective. Unless my partner is going to be on the application for qualifying, we can't introduce that income to help us qualify. That person would have to be a part of the application. Okay. Also holds true. Sometimes we have scenarios where someone is receiving room rents because maybe they have a 2-bedroom apartment. They rent out 1 room to supplement their costs. That income can't be used in the qualifying as well. Now, one of the things we look at is income versus expenses. We call that ratio a debt to income ratio. And that ratio kind of gives us a sense from a qualifying perspective that we don't want those expenses to exceed more than 43 to 45% of pre-tax income, so your before tax income. In fact, in some cases, we can go as high as 45% with that calculation. I think it's important to understand that that is a metric used for qualifying, doesn't indicate affordability. So let's take a look at that debt to income ratio. So let's say we have our housing budget set with principal and interest, property taxes, homeowners insurance. We have PMI in the scenario if we're putting less than 20% down. And let's just, in the hypothetical, say that we're buying a condo that has an HOA expense. So if my housing budget is, let's say, $2,500 a month, my other debts like personal loans, credit cards, card payments, those are at $500 a month. So currently, as a buyer, my expenses are $3,000 a month. Now, we're not going to take into consideration entertainment expense or travel expense, anything like that. We're just simply looking at generally things that report on your credit report. So if that expense is $3,000, which is inclusive of my new housing payment, and I'm making $8,500 a month, that means my debt to income ratio is at 35.29%. So again, 35% of my pre-tax income is being occupied by those expenses. The question I get from clients is, what is the right space to be in from a debt to income ratio perspective? in working with thousands of buyers across the country, I would say probably 33 to 36% is the right number. That's kind of the sweet spot, so to speak. But again, to my point earlier, it's not a necessarily indicator of affordability. That's a conversation we're going to have in a one-on-one session to understand, like, what does a $2,500 mortgage payment feel like if we're used to paying, let's say, $1,000 a month, right? Because that could be challenging to manage through. And so that's how we kind of sort through in designing that home buying plan. Now, the last thing we want to think about is savings for homeownership. That was number 2 on our kind of challenges for first-time buyers, whether it's credit or savings. This is the documentation we need to put together to kind of prove what savings we have. But, it can be a challenge. And so, one of the things that we talk through with buyers is developing a savings plan. And a savings plan is a really simple concept. And what we're looking at in a savings plan is this. So if I'm a buyer right now, and let's say I'm accustomed to paying $1,500 a month in rent, right? But I kind of feel like from an expense perspective, I can take on about $3,000 a month. That means I have about a $1,500 variance in what I think I can spend monthly. But my challenge is I just don't have savings, right? So one of the things I would encourage that client to do is to start saving like you're paying a $3,000 mortgage payment. And it's a really simple practice. So on the first of the month, when I'm getting ready to send out and make my deposit or my payment to my landlord, I pay my $1,500 a month, but that overage of $1,500, I create a discipline for myself that I take that additional $1,500 that I think I can afford in that new mortgage payment, and I put it in my savings account on an ongoing basis. What's cool about that is after 6 months, we're seeing some growth in that savings account. Now our savings is, up to 9,000 after 6 months. After 12 months, we're at 18,000. And really that gets us in a position where we'll have sufficient funds to purchase a home. So it does 2 things. It creates that discipline of savings, but also creates the discipline of, hey, I'm used to paying $3,000 a month. So it's not as big of a leap, if you will, when it comes to purchasing a home. All right, so that's kind of our savings plan. And then you can see on screen, you can see some of the documentation used in verifying assets. Just as a side note, gift funds can also be used for home ownership. That's where a family member is helping contribute towards my home purchase. There is no seasoning requirement for gift funds, but for other funds that I've saved up, I have to show that I've had that money for at least 60 days. Now, in the state of Virginia specifically, I think most of us are either from Virginia or California. So I'm going to talk a little bit about California program in just a second. But in the state of Virginia, there is the Virginia Housing Department. And what that housing department does is it provides opportunities for low to moderate income households to be able to have resources around home ownership. So in purchasing in the state of Virginia, there's programs like the DPA grant program. There's a Virginia Housing Plus Second Mortgage program, and ultimately those resources will help bring down your out-of-pocket expense, also lessen just the overall expenses for housing. And so every state, so whether you're in Virginia or any other state, there is generally an HFA, which is a housing finance agency designed to help support those low to moderate income first-time homebuyer households. So we would encourage you to get connected with us to learn a little bit more about first-time buyer programs like that. They can help make homeownership possibly a much more near goal for you versus maybe something you have to plan out for a year or 2, maybe 3 years down the road. For those of you who are in California, California has the California Housing Finance Agency, has very similar products to Virginia Housing. There's a program called My Home Assistance, which will help provide that minimum 3% down for your conventional loan and 3.5% down for an FHA product. So those are basically resources that provide to you from the state at a low cost interest rate of 1% for those funds. And like the Virginia Housing Program, the Cal HFA product has reduced interest rates on the first mortgage as well too. So there's a lot of great resources out there to kind of choose from. It's really up to us to kind of figure out together, what is that going to look like for you and how does that look in the design work for your home buying goals? Now, most first-time buyer programs have income limits based upon where you're going to purchase. Since we're doing a VCU class, most of us are in Virginia, but this is kind of what the income limits look like by certain counties across Virginia. You can see, obviously, the Washington, Arlington area is going to have the higher income limits just because of more expensive cost of living, but that does vary across the state. For those of you who are in California, most of the Cal HFA limits are 150% of the median income, depending on where you're going to purchase. So if I'm going to take a guess, maybe you're in Los Angeles, right? So Los Angeles income limit is $194,000. All right, let's talk a little bit about the process, right? So after attending tonight's class, hopefully you've kind of sparked a little bit of interest in home buying, and it's maybe something that is maybe on the goal board for this year or next year. And so I think it's important to understand like what comes next for us. So after leaving tonight's class, you'll have the opportunity to get connected with us for a consultation. That's where we do a free 30-minute session to design your own home buying plan. Well, after that session with me, then we kind of move on to actually the buying process, right? In fact, the output of a consultation is to be pre-approved for home ownership. So we've created this 6 steps of home buying guide for you. And step 1 is pre-approval. And pre-approval basically means that I've been certified by American Pacific Mortgage in my lending. So I'm free to go out and start looking at homes. That pre-approval is good for 60 days, but if it takes you a little bit longer to go find a home, that's totally fine for you too. We can easily recertify that pre-approval. So step 2 is actually the house hunting. Usually it's going to start online, where you're kind of just figuring out what neighborhoods work for me. I'd encourage you to connect with a realtor that's going to be an expert in that community that can help negotiate contracts for you and ultimately submit an offer for you. Now, one of the questions we get often is, I've heard there's been some changes with commissions that are paid to realtors that represent me as a buyer, right? And that's absolutely true. About 4 weeks ago, the NAR settlement, so the National Association Realtors settlement, started coming into practice now with transactions, and obviously we've been helping clients since that. Ultimately, what it means is that you as a buyer, when selecting a realtor to represent you, will have an agreement together. And that agreement is essentially how that buyer's agent is paid. And that could be negotiated through the seller paying for it, could be through you paying for it, could be split equally, whatever the agreement looks like. And so I think there was a lot of kind of unknowns with that. I'd encourage you, if you do start working with a realtor, ask some questions about what that agreement looks like. Those agreements have various timelines too for the realtor partnership. But I would encourage you still to use a realtor. I think it's an important part of the buying process. But that house hunting phase would come at step 2, and that house hunting phase could take 2 months. It could take 2 years, depending on where you want to purchase and kind of when you're ready to go. Now, if you do have an accepted offer with a seller, then we move to step 3. And step 3 is called entering escrow in most parts of the country. And what that means is you have an agreement with the seller to purchase that home. From day 1 of acceptance, it usually takes about 30 days until you're getting keys to the house. Now, sometimes it can be condensed as short as even 14 days, depending on your respective state. But day 1 starts at step 3. And as a buyer, that day you get a call from us saying, congratulations, you have an accepted offer on your house. We'll kind of talk a little bit about your contract that you've agreed to with the seller, and then kind of talk about financing and schedule you for a follow-up video session. That's where you and I meet one-on-one to make sure we've kind of reaffirmed everything about the financing, what interest rates look like, how much my out-of-pocket expense look like, monthly payment, and really kind of have a good understanding of the timeline of events. So that all happens at step 3. And then as we kind of move through the process, you'll be responsible for what we call as an earnest money deposit, which ultimately is a deposit you make as kind of a good faith deposit in the transaction. Tells the seller that you have a financial interest in the transaction. That deposit in most parts of the country is 1 to 2% of your purchase price. That money will generally be held in an escrow account, and it's protected by contingencies in your contract. And those contingencies usually state that you can get your house appraised to make sure the house value is supported by market data that matches your purchase price of your house. We want to make sure we get the house inspected, which your realtor will help organize those inspections. And then we'll get your loan approved. So as your lender, we'll get all those steps completed. So the loan approval as well as the appraisal. And then as we kind of move through the 6 steps, you have step 4 is going to be processing and underwriting. That's kind of more of the administrative functions. We're going to basically be verifying your employment, credit, assets, all the things we need to kind of lead into the next step, which is the underwriting process. And at step 5, we issue an underwriting approval. That also takes you about 2 to 3 weeks into the process. And at that point, if everything checks out from an appraisal perspective, loan approval, you feel good about your inspections, then you can sign off on your contingencies. And by doing that, basically tells the seller that you're comfortable with your investigations you've done, and you're ready to move to the closing phase of the process. Now, before we do that, we do issue to you a final closing disclosure on the loan side of things. That final closing disclosure gives you a 3-day cooling off period before you get to the final stage. Now, as you go through each one of these milestones, you're getting disclosure updates from the APM team. You get initial disclosures that happen within 3 days of your accepted offer. And then as we kind of move through the process, once your interest rate is locked in, you get a set of disclosures. And at the very end, you get your final closing disclosure. And then that brings us to step 6, and that's the day we do signing of loan documents in person with a public notary. It's also the same day that you're going to wire in funds that are still owed in the transaction. And then after your money has been received in, your documents are signed, and as a lender, we deposit in your mortgage funds to the escrow company. They reconcile all those funds, then record documents with the local county recorder's office. They usually record a grant deed to transfer ownership as well as the deed for the loan. After all those things get confirmed, then you become the homeowner. And that's the best part of my day because I get a chance to call all of our new home buyers each day. I got a chance to make 2 of those calls throughout the day, and it's the best part of the day. It's a huge celebration. Of course, the process doesn't come with, concern from our buyers because it's the first time, right? But, we do have a high touch experience. We leverage technology. We support through our high touch communication, whether it's text, call, emails, because we understand this is going to be one of the biggest purchases you make in your upcoming financial futures. Well, if you're thinking about getting on that path towards homeownership, this class was helpful, hopefully a helpful tool in launching you into homeownership. I'd love to get connected with you for a consultation. That's a 30-minute session we do together. It starts with a really simple 3-step process. It's an online application. We do a really easy soft credit check. You'll upload proof of like pay stubs and your recent asset statements, and then we meet up on video. And we work together to kind of design a home buying plan here for you. So whether you're going to buy this year, which would be pretty ambitious because we only have three months left, or if it's a 25 goal or a 26 goal, we want to just be a partner for you in that pursuit. Now, if you have some questions after tonight's class and just want to get connected with us to answer questions, you can sign up for an introductory call. That's always a great way to just, first of all, start the conversation with us. You can use our links here that you'll find in the presentation to schedule any one of those options for you. This is what the consultation looks like. It is a free service we provide. We want to learn a little bit more about where do you want to buy? What's your budget look like? Can we help you kind of understand better about your credit? Are there some first-time buyer programs that would be a good match for you? And just kind of help you understand the components of the financing. And then, as we've talked about earlier, if you decide to get pre-approved, we can do that and help you whenever that time is right to start your home shopping. Now, as we get towards the end of class, I just want to point out a couple resources to you. One is our mobile tool. I mentioned a high-touch experience, but also leveraging technology. Mobile can do that for you. It can allow you to apply right there. There's calculators available through our mobile tool, and you also get push notifications in real time as you move through the process of home buying. And we're all joining together because of our fantastic VCU partnership. We also have other community partnerships across the country. So if you have friends, family, maybe some coworkers that you think might enjoy some stuff like this, we'd encourage you to check out some of those partnerships, or they can check out some of those partnerships and our upcoming class schedule. We do about 60 classes a year all across the country in different markets. So if you want to do a refresh of this class down the road, or you want to invite someone and attend one of those classes, they can check out all of our upcoming classes at mortgageeducate.com. And here's all my contact information. So if you do want to get connected with me after tonight's class, feel free to reach out, schedule an appointment, or message me, whatever's good for you. And this class, again, will be up on our YouTube channel tomorrow. We'll also include the presentation material for you so you can check that out, maybe do a look back and see some things that kind of stood out for you. And we'd encourage you to follow us on our social channels. Not only do we have our YouTube channel that has some different material up there, but we try to put some good content on our Instagram to help kind of support you on this journey towards homeownership. Well, I know we're getting close to the top of the hour, so I promise carving out some Q&A here for us. I know I didn't get many questions during class, but maybe you guys have some questions you want to ask as we get towards the top of the hour that can help answer for you. I do appreciate everybody spending their Wednesday night with us. So feel free to drop any questions into either the Q&A or chat, and I'll get those answered for you. I know I'm probably in front of dinner too, so I understand if we don't have any questions. So I get that if you guys are ready to kind of get out of there for dinner. So totally understand. But yeah, feel free to, if you do have some questions, just drop in the chat or the Q&A, whatever's good for you. Okay. I think we're good. I think that hopefully is a good sign that I was super thorough. All right. Well, let's see what we had. Okay, actually, we did have one question that came in. So for those of you that are kind of hanging on, let me just. So the question is, can you clarify on education criteria? Would a field of study work? So yeah, so the field of study would work when we're talking about that 2-year requirement. So if I have kind of a direct relation to my degree and then where I'm working now today, that'll fulfill that 2-year requirement. Yeah, absolutely. Thanks for that question. Another question was, will we have access to these slides after the Zoom? There were a few that I missed. So yes, that will be, so just a reminder, so we have your email because you registered for our class. So we'll go ahead and email you out the slideshow, and then the recording of this class will be up on the YouTube channel tomorrow as well too. And the handle for our YouTube and Instagram is jmeda mortgage, which you can see on screen. So you can check out that stuff there. And then question was, if we want to schedule an appointment, do we need to have any materials ready for the meeting? So depends on what type of consultation. If you want to do the full consultation, I would encourage you to start the 3-step process so that you can do just a really simple online application and upload the documents. And then you would just schedule the video call at your convenience. So you can do that or do an introductory call, whatever's good for you. This is the typical things that we would need as part of that process. This actually should be the 22 and 23 W-2. I have a little bit of a typo there, but yeah, that I would just have that prepared. But whatever is easier for you, we want to make this an easy process for you, and then we can start kind of collaborating on what that looks like for you in your home buying plan. Question was related to the buyer broker agreement. Once we sign the agreement, can we still change agents? You're going to have to, that'll be a question for the realtor because usually it's going to have exclusivity in that agreement. And so that's why you want to be really careful with those agreements. There's also timelines to that. So I would just double check with the realtor. And then another question was, if we have a cosigner due to insufficient income, will that disqualify us from the first-time home buyer program? Usually it will. So most first-time buyer programs do require all parties to be first-time buyers and to be occupants of the new property. All right. You guys are giving me some good questions at the end. You held up all the good questions to the very final part of the class. So I like it. All right. Okay. And then just a follow-up to my last answer. It's like the person was on the deed but never on the mortgage. Is that eligible? So usually if you're on the deed, then that would disqualify you from a first-time buyer program. Now, some first-time buyer programs, depending on the state you're going to purchase on, if you haven't lived in that property in the last 3 years as your primary residence, even though you're on the deed, then you could still be considered a first-time buyer. All right, great question. Appreciate that. All right. I think I got them all. And I think the follow-up question is, how could I check that out? Well, I think really it's just, if you're still on the deed, if you haven't lived in that residence for the last 3 years, then you could potentially be a first-time buyer. Let's connect off screen maybe for an introductory call or off call, and then maybe let's talk a little bit about where you're going to purchase that. If it's specific to Virginia, we can kind of dive into the Virginia first-time buyer guidelines because there's some little nuances to that I think we need to kind of talk through. All right. And you're welcome. Absolutely. Cool. All right. Anything else? I appreciate everybody asking these questions. Let me just make sure in the chat we don't. Okay, cool. Got that. Got that. I think somebody just put in the maybe comment on the real estate broker buyer agreement. So you guys might want to check that in chat. So you or your agent must agree to serve the buyer brokerage, which shouldn't be an issue because a good agent would not want an unhappy client. So yeah, probably right. I just have seen some pretty tight agreements out there across the country, like 12-month timelines that, it's exclusivity for 12 months. So yeah, just double check. I mean, obviously before we sign anything, we really want to understand the language in it. Another question was, the percentage rate is negotiated between the buyer realtor or between the seller realtor. So that will be, the buyer will negotiate with their broker that's representing them, or their realtor that's representing them. And then when an offer gets submitted to a seller and or listing agent that represents the seller, then those percentages and or dollar amounts would be kind of negotiated out. So just to give you an example, let's say someone's purchasing a home for $500,000, right? And the agreement is for the listing agent to receive 2% and the buyer's agent to receive 2%. Now, that would be a total of what, $10,000, right? So, $20,000 in the transaction. So, your agent representing you would receive $10,000, and then you could, if that agent's commissions could be negotiated, be paid for by the seller, or maybe you're saying, I'm going to split half and half. I'll pay 5,000. The seller's paying 5,000. So there's not really kind of a rule of thumb of percentages per se. Every little transaction is a little bit different. And so we've had a little bit of everything. We've had buyers that are paying a portion of it. We've had sellers that are paying all of it. It just really depends on ultimately what's negotiated. I think it's something that's getting kind of sorted out in terms of, the fluidity of it. I think it's a good thing, honestly. I know I'm speaking from the lender perspective, but, ultimately this is transparency to buyer and seller, which I don't think we had before. I think it was just assumed that this is what was earned. But, lending has always had these transparencies, pieces to it. And I think that's important to have in the entire transaction for a buyer. And then another question was, if at the end I cannot get a home, would I be held financially obligated to pay any fee? So I think that's reflective to maybe the consultation, or maybe in escrow. So let me give you two things. So one, if you do a consultation with us and we maybe have to have a longer timeline for your home buying plan to purchase, that's totally fine. Regardless of if you're going to buy today or buy 2 years from now, we don't charge anything for consultations. If you're buying a house and let's say you're in escrow, and for whatever reason, the financing just doesn't work out, as long as you're in contingency period, you can still get out of that contract and not be impacted financially. Okay, great question. Okay. I think I got that one. Okay. And I appreciate everybody kind of hanging tight, because I know you're probably seeing some good questions coming in. So yeah, that's hopefully helpful for those of you that are maybe thinking around those same lines too. Okay, I think we did it. All right. Well, thanks again for spending your evening with us. Hopefully you found some things that were useful for you on this path towards homeownership. Sounds like we already have, some of you are already considering doing a consultation with us. Love to get a chance to just be a partner for each of you in this path towards homeownership. If there's anything I can do to help you, please don't hesitate to reach out. Have a wonderful evening, and we'll talk to you soon.